Welcome to the second edition of PortfolioFocus. My name's Matthew Zschech. Today I'm here with Dr Ron Bewley from Woodhall Investment Research, and we're going to talk about subjects: should I be leaving all my money in the bank? Cash. I mean, is cash safe at the moment? We're talking about cost of living. Interest rates are going up and down. You know, what are the recommendations? What should we be doing? Thanks for coming today, Ron. I mean, we're getting a lot of questions at the moment. Is my money safe in cash? We've seen a significant amount of money, go into term deposits since the GFC, heading towards cash-based investments.
It's a very complicated question, that, far more complicated than most people realise. That, yes, your money is safe in cash, it'll be there in the future if you leave it in the term deposit. But the real question to do with safety in cash is, will you have enough money when you come to take it out? Because two things eat into your cash while it's sitting in the bank doing very little. You're getting an interest rate on it, but away from that comes your tax, and that comes first, and then after that comes inflation. So if you were to say get 6% on your term deposit, and you're paying, say, taxes to about a third, that's 2% comes off that 6%, so you only got 4%, not 6%, because after-tax returns are the only ones which matter, unless, of course, you're in a super fund. So that 4% is your increase in value over a year, and that's what the bank gives you in return for you lending it its money so you can lend it to somebody else from a house. But then the inflation bogey comes along. He's about 3.5 at the moment, and that comes off the 4. So you've actually got 4 minus 3.5. You're only getting 0.5% return on your money, and to double your money at 0.5% a year takes 144 years.
We're seeing a lot of people at the moment talk about cost of living. Cost of fuel is going up. We've seen interest rates go up. We've seen interest rates go down. Housing affordability is a big issue within Australia. They have their investment portfolios. I mean, in all of this, it's a big complicated issue, but how do people stay ahead?
Staying ahead is the tricky part, and that's why we say you have to be only partly in cash, or maybe not in cash at all for some people, depending on your circumstances. And some things like an insurance policy could cover some of the unforeseen circumstances if you're fully employed and get sick.
Yes.
So different parts of your career, different things are necessary.
Sorry, under-insurance is a big thing within Australia.
Insurance, not as we often see on television for funerals, that's the least important thing. It's for incapacity insurance if you can't go to work.
Yes.
6 months laid off from some accident and you need some money from somewhere, so it's really important. But the cost of living is actually very difficult to measure because everybody spends money on different things, and yet there's only one inflation rate that the government looks at. And they assume we're all the same when they're talking about what inflation is. So in the recent numbers, fruit prices went through the roof because of the Queensland flood.
Yes.
So if for some reason you're dominated by food and not by something else, it will hit you harder than someone like me who hardly eats any fruit at all. The Reserve Bank only really has one instrument, changing the interest rate, to change everything in the economy. And it's mandated to keep inflation in a band of about 2 to 3% and keep full employment. And all it can do is put rates up and down. And yet we've got mining sectors, we've got retail sectors, we've got holiday makers, we've got everybody, and all they can do is nudge rates up and down. Now, we didn't have a recession like the rest of the world. We got through it really quite fine, probably because of China. So then as we came out, there was an inflation pressure from the mining sector. So they raised interest rates from really, really low levels to low end of average. So currently, you may not believe it, interest rates are quite low compared to normal.
Right.
At the low end. Not particularly low, but certainly on the low end. So we've got to this situation, but the Reserve Bank has tried to introduce an extra policy instrument, and that's jawboning. So what it's been doing for the last 6 months or a year is hinting it's going to increase rates to try to get you to change your behaviour without actually increasing them. And it's worked. It took the heat out of the property prices so much so that the flats are going down. So they're trying to introduce that extra side to it. But now we're in a situation where a couple of weeks before all of the turmoil following the American debt ceiling, they were talking about raising interest rates, and then Westpac came out and said they should fall by 1%. Then the money markets priced in a 0.5% cut, and all sorts of things are going on. And consumers, investors should be worried because they don't know what's going on.
Yeah, exactly.
And the Reserve Bank probably doesn't know what to do either, because you can't just put interest rates up or down and affect just the mining sector or just whatever. If you go back to the recent inflation number of a couple of weeks ago, It came out as around, I think, 3.5%, a little outside the band. But the main sinner in that band that forced interest rates up was fruit and veggies. Right. And that was from Queensland. Now, if you put interest rates up to 100%, that would not have changed the drought. So why should you react to that? Yeah. Putting interest rates down aren't going to affect those fruit and veggie prices. In the long run, maybe there's some impact on costs of travel and things like that. But in the short run sense, it has no impact. So therefore, they shouldn't react to that. But then it becomes the grey area. When do you go from, oh, it's fruit and veggies, or it's just this, or it's just clothing, or it's just Harvey Norman? Yeah. So it's a complicated question. Yeah. And people should be thinking about it. But the question is, they shouldn't try to guess. They should not mind at all, other than being able to plan. Can they afford the repayments on their loans? Yes. And allow for some margin, maybe a 2% increase, even if you think they're going down. Yep. So if interest rates go up by 2%, I'm still fine. If they don't, I'm better off.
So, I mean, the other big thing that we're hearing from clients at the moment is they just can't understand why the RBA is increasing rates and then quickly dropping interest rates. I mean, with people in moving from a variable fixed income loan through to a fixed interest loan, what should they be looking at?
Again, that's a complicated question, because the fixed rate loan versus the variable rate loan should never, ever, ever be because you're predicting rates to rise or fall. Nobody can predict where rates are going. They just take, if you like, big bets in big banks and try to manage that. You take a fixed pass in your loan to manage your risk. So, for example, when my daughter got married and bought an apartment with her husband, who was still a student, medic student, she fixed all of her loan to guarantee she could afford the repayments no matter what. As it turned out, she would have been better off with the variable, but she then wouldn't have slept. Okay. So it's all about managing risk.
And it comes back, sorry, to personal circumstance as well. Yes. I mean, really, and that's where, again, we have to iterate, you need a personal plan. Yes. I mean, a variable rate for one person's circumstances may not be the same in another circumstance.
Well, I did a little exercise not so long ago to work out over the last 20, 30, 40 years, if you've gone variable or fixed, which would you have been better off with? And the answer is variable. Yes. Surprisingly, by quite a bit. But at times you would win with a fixed rate, but you should never be jealous of what you could have done. Yeah. Part of your plan is lack of jealousy. Somebody's always going to do something better than you. It's like being in the Melbourne Cup. You're not going to get the winner. If you're going to cry, if you're not going to get the winner, don't bet on the Melbourne Cup. Yeah. Same with investments. You don't want to be the best. You want to be in the middle of the pack, getting solid returns year after year. We've
seen a massive amount of money flow into term deposits post-GFC. There's just been a rush towards almost conservatism from an investment sense. We talked a little bit about how effectively you can be in a term deposit with inflation. You can be marginally going ahead, if not in some circumstances going backwards. It sounds like to me, I mean, the debate and the argument really is all about balance. Balance between term deposits, balance between having market exposure, and really that will propel you beyond just the inflation argument and cost of living argument. It's all about a balance argument. It's all about balance in finance. But there's nothing wrong with cash. Cash is not a dirty word. Agreed. It's the right amount of cash. Yes. And for example, if you're getting old and you don't feel that well, you might need a bit more cash than if you're fit, young and healthy. In fact, you may need no cash other than enough money to last you through a month if you're 30 years of old, healthy with no kids and no mortgage. But as you get older, you might need a little bit more of a reserve to say that, and I used to use this maxim before, and I had it for myself, that I want 2 years worth of guaranteed income no matter what happens to the market. Yeah. So that if the market falls, I've still got money for 2 years guaranteed, and then after that 2 years, I'm assuming that the market will come back at least part way. And that's what saw me through the GFC. But I didn't do it via cash, I did it via insurance policies and the like. Right. I suppose again it comes back to, planning to have a plan. Yes. Everyone's circumstance is individual. I mean, if you're heading towards retirement, you want surety of income. If you're, in the 20-something demographic, you're wanting growth. And if I could add something there, the worst plan is from your mate, whether it be in a cafe or a pub. Agreed. Just because your friend's doing it doesn't make it good. Yeah. It may be totally inappropriate for you, and your friend could be wrong, particularly if there's not a licensed advisor. So go to the licensed advisor like you go to the licensed builder or the licensed lawyer or the licensed accountant. Okay. Planning is very, very difficult. It's a full-time job to plan everything. Somebody should be doing it for you unless you've got the time to do it yourself. Thanks, Ron. That's the close of our second edition of Portfolio Focus. I think we covered off some great points in this session. One about term deposits and cash. Is cash safe? Inflation, cost of living. And there's two real things that I took out of today. One is really balance. I mean, you need to look at balance between having cash in the bank and also having investments in the market or investments in property. And the other one too is basically plan to have a plan. See your financial planner, get some plans in place, and really look forward to the future. Thank you.